learners, welcome to our session today. I am your instructor, CPA Ringo Frederick. In our class today, I want us to discuss the concept of group accounts according to IFRS number 10. So, commonly known as consolidated accounts. And remember in the previous class when we introduced the whole concept of groups till to the point whereby we had looked at the concept of structures, group structures. In our previous video, which you can get the link just below this video, we had clearly introduced the whole concept of consolidated, or rather consolidation, which of course you're talking of group accounts. So in our class today, my good students, it is a continuation of the same. So just a recap on what we did previously. We say that anytime you're talking of group accounts, basically, we are looking at company reporting its financial statement as one entity, as much as I'm having various entities. So in this case, we'll find that reporting our financial statement as one entity, basically this is what you're terming them as what? As group. And in this case, if you can recall, the investee companies that we talked about, we talked of the concept of number one, subsidiary. Subsidiary is an investee company where a parent is holding 50+%. The company is holding 50+% of the shareholding of that investee company. We talked of number two, we talked of course, joint venture. Joint venture is whereby you'll find that the parent is holding 50%. In that, we have joint control with another company. Talk about associate. Associate, recall, we say that this is an investee company where the parent is holding between 20% to 49% of the shareholding. And finally, we talked of simple investment. So basically, simple investment is where the parent is holding, that is of course 20% and below. That is of course is holding, that is talk of 19% going backwards, right? So in this case, these are the investee companies that we normally tend to talk about. These are investee companies that we normally tend to talk about, and what you must always tend to have at the back of your mind. Very key concept. So the concept that I want us to discuss today is method of acquisition. You'll find that a company can be acquired. Now, in this case, of course, the whole of these investee companies are being acquired by what you are referring to as the parent company, as the holding company, the mother of all these investee companies, right? So you'll find that in this case, anytime you're talking of a method of acquisition, in this case, I will be talking of method of acquisitions. I can pay our consideration in various manner. You'll find that practically, as much as you are acquiring a company, I might not pay only in cash. There are other avenues that you can consider in acquiring a company. And these other avenues will include, number one, we can decide to pay cash at once. We can decide to do aspect of a share-to-share exchange. And of course, we can also talk of number three, talk of deferred cash. Talk about aspect of deferred cash payment, where yes, I'll be paying partial, and in this case, at times you can also refer to it as what? The piecemeal acquisition. You can refer to it as a piecemeal acquisition. Also, another key element that you can also look at here, my good students, you can also talk about another form of acquisition, which in this case we normally tend to look at it That is, of course, number 4, contingent consideration. Contingent consideration. Contingent consideration. So all these are the method of aspect of consideration that you can always consider. That is, of course, cash consideration, share-to-share exchange consideration. Talk about aspect to do with maybe deferred cash payment consideration. So all these are methods that you can use to pay for acquisition of either of these investee companies that we have talked about here. So that will be very, very vital. That will be very, very, very vital to understand. Now, once we have that, the other key element, of course, cash consideration, we've talked of it. These are normal considerations that we normally tend to talk about most of the cases. Share-to-share exchange is also another unique area of acquisition, which we'll also be looking at it. Talk about deferred cash payment consideration. And this is where our focus of our class today will be the aspect of our deferred cash payment consideration, as well as contingent consideration, which we'll also be looking at it later on. So in this session of ours, my good students, I'll also want us to do a recap on some of the main concepts that you can't do without. For you to be a good student in group accounts, you'll find that there are some of key concepts that you must always tend to have at the back of your mind always. So at this point, I want us to look at this common case in group accounts, whereby in this case you can start with the most common. Talk about aspect of goodwill on acquisition. Talk about goodwill on acquisition. Goodwill on acquisition. Goodwill on acquisition. Goodwill on acquisition. Many times you'll find that when I am acquiring an investee company, and specifically at this point we normally tend to talk of more so subsidiary or even associate can have the same, but basically our focus will be on goodwill acquisition. You'll find that anytime I'm acquiring a subsidiary, you'll find that at times the purchase consideration might always be more than the net assets of the subsidiary. So in this event, you'll find that I'll be having an item known as goodwill. So in a very simple term, we'll find that anytime you're talking of goodwill, basically, goodwill is just the difference between our purchase consideration. Goodwill is just the difference between purchase consideration, purchase consideration, also known as what? Cost of investment. Cost of investment. We less what? Net assets. We less net assets on acquisition. Less net assets on acquisition. Less net assets on acquisition. And at this point, you'll find that it will be very key for us to know how to go about this. Basically, just understand in a very, very simple manner that goodwill is just the difference between our purchase consideration, or rather cost of investment, with less our net assets on acquisition. That would be the first step that you must always tend to have at the back of your mind for you to be a good student in group accounts. The other key element that you must also be very good at, my good student, is for you to understand how will you determine your net assets. To determine our net assets, you'll find that this will be very, very key and very important. To determine our net assets, basically, we normally tend to talk of the following. At this point, we are acquiring a subsidiary, right? And in acquiring a subsidiary, we say that at this point, you'll find that the parent company has a controlling interest of 50+%. So the other percentage, we normally refer to it as what? Non-controlling interest. The portion or the percentage of as a subsidiary that the company is not controlling is what you're terming it as the non-controlling interest, okay? So to determine our net asset, basically, we'll be talking of the following. I'll always be talking of, I'll always take the aspect of course, the ordinary share of this company. Talk of the ordinary share. All these are of subsidiary. I'll be taking share premium of the subsidiary. Okay. I'll be talking, of course, of the other aspect here, which you normally refer to it as the fair value adjustment. Fair value adjustment. Fair value adjustment on acquisition. Talk about pre-acquisition profits. Pre-acquisition profits. Pre-acquisition profits. So you'll find that this is what will give us what? Our net assets. The moment we sum it all up, this sort will give us our net assets. This sort will give us our net asset. This ideally we are talking of what? All these items are for subsidiary. All these items are for subsidiary. All these items are for subsidiary. Very key to understand. Of course, the other key element that we must also be able to understand here is aspect of these items where I'm talking of fair value adjustment. So fair value adjustment normally comes as a result of what? First of all, let me have the total here. Fair value adjustment, it normally comes as a result of revaluation gain. It normally comes as a result of revaluation gain. And how will this happen, my good students? This will happen whereby you'll find that the fair value is more than what? Is more than the book value on acquisition. It's more than the book value on acquisition. Where there is this state, you can be told that on acquisition of a subsidiary, a certain item was more than the book value with a certain amount, which in this case, we are referring to it as what? The gain, revaluation gain. So if the fair value is more than the book value, in that case, I'll be having a gain. And of course, opposite will happen. If the fair value is less than the book value, of course, I'll be having what? Revaluation loss, right? So in this event, I'll have to adjust our fair value from, of course, what? We'll have to adjust our fair value in determining our net asset. Then other key element here, we are talking of pre-acquisition profits. And this is an area that I'll also want us to be very, very key on in the event that we are looking at consolidation. In the event that we're looking at consolidation, these are also one area that we must always tend to be very, very key on. I want us to understand this case, my good students. I want us to understand this case. You'll find that on acquiring a company, in this case, assuming in our case, this subsidiary is running financial year is from January to December. This subsidiary financial year is from January to December. So what will happen? I want to explain the aspect of pre-acquisition concept, the whole idea of pre-acquisition, and of course the aspect of post-acquisition as well. So you'll find that my financial year is running from January to December. Okay? Here comes a company, a parent will acquire this subsidiary, say in between the period, say like on 1st June 2022, for example, right? So what will happen is that this is the acquisition date. This is the acquisition date. This is the acquisition. This is the acquisition date. So the period before acquisition, in that before we acquired this company already and past also compared to the other years I've been operating. So this is what I'll be terming it as what? Pre-acquisition. This is what I'll refer to it as what? Pre-acquisition. And any transaction relating to pre-acquisition, it will assist us to determine what? To determine our goodwill component. Any transaction before we acquire the company, it normally assists us to compute our goodwill. That is what you should always be having at the back of your mind. Then, talk of after acquisition. After acquisition, I'll be having what we normally refer to as post-acquisition. Post-acquisition. I'll be having what we normally refer to as post-acquisition. And you'll find that post-acquisition, basically, it will assist us in determining our retained earnings. It will assist us in determining our retained earnings. Any transaction of post-acquisition, it will always assist us to determine what we are referring to as retained earnings. So this is always very key in determination, pre-acquisition. It is always very key in determining what? In determining our goodwill, where we are saying that at this point, for pre-acquisition, my good students, for pre-acquisition, this is what I'll be having. This is what I'll be having. You see, pre-acquisition profit. Remember, we're talking of what? The subsidiary. We are talking of the subsidiary. So that is very key for us to always tend to do what? For us to always tend to understand. For us to always tend to understand the concept of pre-acquisition and post-acquisition and post-acquisition and post-acquisition and post-acquisition. Now, after we have that in mind, probably you'll also find that in determination of our goodwill, other key element that you must always be having at the back of your mind is method of goodwill computation. We normally tend to talk of two methods: the aspect of partial method and the aspect of full method. And this is very easy to distinguish. In the event that you are talking of partial acquisition, like in our case here, in determining our net asset, I'll only be taking the parent share. I'll be taking the parent share. If at all you are talking of what? Partial method. In the event that you are talking of partial method, where I want to determine my goodwill. I'm going to take my purchase consideration. I deduct the net asset of the subsidiary, but parent share only. Parent share, very key. For full method, where I'm required to determine goodwill using full method, which, by the way, most of the cases, in the event that the examiner hasn't specified, you must always use, or rather is always advisable that we use what? The full method. So in determination of our goodwill using full method, at this point I'll be taking the parent share and the NCI share. This is what Mwalimu is saying. This is what Mwalimu is trying to tell us, guys. I want this concept to always stick at the back of our mind, so that in the event you're having such a question, it should always be very, very easy for us to handle it. So this is what Mwalimu is saying, that partial method, in the event that we need to determine our goodwill using partial method, this is what we'll be considering. I'll be taking our purchase consideration here, talk of course, our purchase consideration. I less the net assets of the subsidiary, net assets of subsidiary. Of course, you're talking of what? Group, or rather parent share only. PS, parent share. And basically, these are our net assets, right? Then, when I'm talking about the aspect to do with the full method, for full method, this is what I'll be having, and you must always be having this at the back of your mind, right? I'll be having my purchase consideration or cost of investment, the amount that we've paid, okay? For the parent amount that it has paid. I'll be taking the fair value of NCI. I'll be taking the fair value of NCI. I add it there. Then, on that event, my good students, whatever that you're going to do, we're going to deduct what? The net assets of the subsidiary. Net assets of our subsidiary. Net assets. In this case, you're talking of what? Both parent share plus what? NCI share. Both parent and NCI share. So that as at the end of the day, whatever that I'll be having here, of course, should give us what? Our goodwill. Total goodwill. In this case, I'm using what? Full method. In this case, you're using full method. In this case, you're using full method. So once you have this idea of goodwill, you find that things will always be very easy on our end. Things will always be very, very easy on our end. That is one factor that we must always tend to have at the back of our mind. The other key element that you must be very good at, my good student, after goodwill, in this case, these are the concepts of UPS. Allow me to raise this case. We are talking of unrealized profit, UPS. UPS on sales, UPS on fixed asset, either way. So we are talking of unrealized profit. Unrealized profit, unrealized profits. This is also very key that you must always tend to have at the back of your mind, whereby I'm going to try to explain it in a very simple manner that if you have it, you'll find that things will always be very, very easy on our end. So at this point, when we are talking of UPS, basically, what do we mean, my good students? UPS will come as a result whereby I'm having a parent selling an item to, say, like a subsidiary, or the other way around, subsidiary selling an item to a parent. And in this case, probably as at the end of a particular period, these items are still in store. So in that event, you'll find that probably I'd sold it at a profit. So this profit is what I'll be terming it as UPS. In a very simple manner, basically UPS, my good students, what Mwalimu is trying to say is that unrealized profit basically arises when goods sold to a group member remained unsold at the end of the financial period. That's a very simple definition of UPS. Basically here we are saying that UPS is simply, it arises when goods, at this point unrealized profit arises when goods sold to a group member, 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 remained unsold at the end of the period. Remained unsold, remained unsold, remained unsold, remained unsold at the end of the financial year. At the end of the financial period. At the end of the financial period. At the end of the financial period. Basically, that is what we are referring to as a UPS. And you'll find that unrealized profit, basically, for you to determine your unrealized profit, this is very easy. For you to determine your unrealized profit, assuming on a closing inventory, whatever that you normally tend to do, we normally tend to take, of course, our profit margin times the unsold, times the unsold, times the unsold inventory, times the unsold inventory. Profit margin times the unsold inventory, that is what will give us what we are referring to as UPS. That is what will give us what we are referring to as UP, unrealized profit on closing inventory in this case. So, assuming in this case, in a very simple concept, assuming that in this case, my good students, I'm having a parent company, I'm having, say, a parent, sold goods to a subsidiary, and at this point I've sold goods to a subsidiary, goods worth, say, like 10 million. And we had a profit margin, goods worth 10 million, and our profit margin in this case, our profit margin was, say, like 20%, okay? So at the end of the financial year, probably subsidiary managed to sell, say, like 3/4 of the items. Sold items are, say, 3/4. So you'll find that it is a quarter which will have remained. So this quarter of 10 million in this case, I'll be having unsold goods. I'll be having our 10 million here times a quarter, which will give us a figure of how much? Is it 250,000? I'm having, of course, a quarter times 10 million, of course. I should be talking of almost, that should give us, of course, 2.5 million, right? This should give us 2.5 million. So this 2.5 is what is in the inventory. And remember, these goods were sold at a margin of 20%. So therefore, times 20%, I should be having times 0.2. So therefore, my unrealized profit, I'm going to have what? The 50,000. Or rather, in this case, I'm having 500,000. So unrealized profit will be 500,000. Basically, this is a concept, a simple way for you to understand what unrealized profit is. And before we go to unrealized profit on a fixed asset, you'll find that in this context, my good student, you normally tend to consider on this unrealized profit, there's a very key concept that you must always consider. And basically, this is consider if it is a downstream transaction or if it is an upstream transaction. I know you guys are wondering what are these downstream transaction and what are these upstream transaction. This is what I want you to have in mind. That in the event that we are dealing with an unrealized profit, I've clearly stated that you must always consider if you are talking of a upstream transaction or if you are talking of downstream transaction. And this is what I'm going to explain. In the event that you are talking of an upstream transaction, because right now we have an idea of what UPS is, right? Now, in this case, you're saying that we'll be talking of this concept of either talk of upstream. Let us start with upstream transaction. Upstream transaction. Upstream transaction is whereby I'm having subsidiary selling goods to the parent. This is what I'm terming it as upstream transaction, where subsidiary is selling goods to the parent. I'll be having what we're referring to as aspect of an upstream transaction. And therefore, in the event that I'm having UPS here, you'll find that subsidiary will also be part of it. And remember, in subsidiary, we are not owning 100%. There's a percentage which is owned by the other members, which we're referring to them as what? As NCI. So how are we going to record this in the event that you're talking of what? Of an upstream transaction. In the event that you're talking of an upstream transaction, basically, we are going to debit our retained earnings. Retained earnings. This is, of course, what? With a group share. And again, we debit our retained earnings. Retained earnings, this is what? Under NCI, non-controlling interest, with the NCI share. Then, of course, you're going to credit what? Our inventory. We're going to credit our inventory. These are difference that I want us to understand. These are difference that I want us to get, my good students. We're saying that to record our upstream transaction, basically with the UPS, we are going to debit our retained earnings. That is, of course, group retained earnings of the group. That is of the group share. And we debit our retained earnings. This is NCI on the side of the NCI. Then, other form of transaction on UPS, you normally tend to talk of what? Downstream transaction. So downstream transaction, basically, downstream transaction will occur. Downstream transaction will occur as a result of parent, selling these goods to subsidiary. As a result of parent selling these goods to who? To subsidiary. Where in this case we'll find that the aspect of recording this transaction again will be different, because this is what we'll be having. To record our transaction here, my good students, I'll be required to debit now our retained earnings, of course, of the group. Retained earnings here of the group with the whole 100%, because it is only parent. And therefore we credit our inventory, of course, with 100%. We credit our inventory with 100%. So these are very key to note where we are talking of maybe talk of aspect of our transaction, talk of our aspect of our UPS, right? We talk of the concept of our UPS. So this is very key. We are saying in upstream transaction for UPS, in the event that I'm having UPS, we are going to debit our retained earnings to the group share of the UPS and debit our retained earnings of NCI with the NCI share of UPS. And we credit our inventory with the total amount of UPS. Talk about downstream transaction. At this point, I'm going to debit our retained earnings with a share, with 100% actually of UPS, and credit our inventory with 100% of UPS. Very key that you should be able to understand that. Very key that you should be able to understand that. Now, once we have that in mind, also another key element that you can talk about probably is now unrealized profit on sale of fixed asset. Unrealized profit on sale of fixed asset. Also, it will be very vital that you should also understand this. Once you're able to understand the first segment, the other segment, I know it will be very easy on our end. So in this case, I want us to talk about unrealized profit on sale of fixed assets. Unrealized profit on sale of fixed asset. Unrealized profit on sale of fixed asset. I know probably one will ask, Molimo, why are you going through all this before? Why should we just look at a question? No, this is very important to enable us to always understand these entries, right? So talk of unrealized profit on unrealized profit on sale of fixed asset, unrealized profit on sale of fixed assets, unrealized profit on sale of fixed assets. How will this occur, my good students? How will this occur? Unrealized profit on sale of fixed assets, how will this occur? So at this point, basically, we are looking at, maybe allow me to use this, UPFA, unrealized profit on fixed asset. UPFA, unrealized profit on fixed assets. How will this occur? Basically, this will occur, this will arise when a group member transfers an item of fixed asset to another group member and recognizes a profit on such a transfer. Say, for example, I'm having a parent selling an item of fixed asset. I'm having a parent selling, say, like a motor vehicle to our subsidiary. And in this case, you'll find that the parent recognizes a component of profit. Say, if at all, the cost of this motor vehicle maybe was 2 million, the parent maybe sold these goods to subsidiary at, say, like 2.5. So you'll find that I've recognized a component of profit of 500,000, right? Which in this case, you'll find that that profit is now what you are going to term it as what? As an unrealized profit on fixed asset. Where in this case, you'll find that since the asset is not meant for resale, the profit recognized should be eliminated on consolidation. As at the end of the day, I'm not supposed to have this profit, the 500,000. So therefore, we will have to eliminate. Also, another component to be affected, you'll find that I'll be having a component of depreciation, which will also be affected. A component of depreciation, which will also be affected. So therefore, in this case, you'll find that to determine this UPFA, ideally, we'll be talking, of course, of transfer value of the asset, transfer value of the asset, we multiply by the profit margin. We multiply by the profit margin. That is what will give us our unrealized profit on the fixed asset. And you're saying that as at the end of the day, I'll have to eliminate this profit. So the question will be, how are we going to eliminate this profit? That's a big question that we should always ask ourselves. So to eliminate this profit, my good students, this is what we'll always tend to consider. We'll always debit our retained earnings. So I need to debit our retained earnings, eliminating that component. We need to debit our retained earnings. And of course, you are going to credit our property, plant, and equipment, PPE. In that case, you are eliminating that profit. Of course, this one with what? With the UPS, with the value of course, this is with the value of unrealized profit on fixed asset, with the value of unrealized profit on fixed asset. We need to eliminate that. Then what you realize here is that at this point, the unrealized profit on fixed asset will lead us to have what? A depreciation, which is going to be a depreciation overcharge. Why? Because the cost of this item, assuming in this case is 2 million, right? We are selling this item at 2.5. So what does that indicate? In the event that I'm providing depreciation, in the event that we'll be providing depreciation of the subsidiary, you'll find that at this point, our depreciation will be excess depreciation. I'll be having a depreciation overcharge. I'll be having a depreciation overcharge, which this depreciation overcharge, of course, will have to deduct it, will have to eliminate this depreciation overcharge. And how will we go about it? In this case, we'll find that to eliminate this depreciation overcharge, this is what will be required to do. The depreciation overcharge, I'm going to show you how we are going to get that depreciation overcharge. Actually, we can have it here, depreciation overcharge, right? So that you should be able to understand it clearly. Depreciation overcharge, believing that you guys, you've been able to understand how we've arrived at this depreciation overcharge by the fact that the cost was 2 million. In this case, I'm having 2.5. So that is to say, in the event that we're charging depreciation here, if at all it was at 20%, and at 20%, therefore, you'll find that on this other end, I'll be having excess depreciation. And that is to say, I'll have overcharged our depreciation. So depreciation overcharge, simply, we can achieve it by taking our unrealized profit on fixed asset, unrealized profit on fixed asset, we multiply by the aspect of what? The depreciation rate. We multiply by the depreciation rate. That will give us our depreciation overcharge. That will give us, of course, our depreciation overcharge. So we are saying here that we need to eliminate this. So how are we going to eliminate it, my good students? In this case, we need to debit our PPE. We need to, of course, with excess depreciation, we are going to debit our property, plant, and equipment. With excess depreciation, we're going to debit our property, plant, and equipment. Of course, we are going to credit what? Our retained earnings. Reason being, I'm providing more expense than required. So, of course, this is what? This is, of course, with the excess depreciation. This is, of course, with the excess depreciation. With excess depreciation. With excess depreciation. With excess depreciation. So, basically, the concept of UPS is also very, very key for us to always have in mind. And the good thing is that on this case, we have looked at both UPS on closing inventory and UPS on fixed assets and UPS on fixed assets. Now, once we have this concept, the other key element that again maybe is also very vital here is for us to understand the aspect to do with intercompany sales. That one is also very key that you must also have in mind. The intercompany sales. At what point will you be having intercompany sales, my good students? At what point will you be having intercompany sales? In this case, I can just explain it and you can master it because already you had already looked at it. So intercompany sales will happen, or rather intercompany owings will happen, whereby in this event, of course this is the intercompany sales, we are talking of intercompany owings, will happen where I'm having, say, subsidiary is owing, or rather subsidiary is owing parent company as at the end of the period, and therefore also parent probably is owing subsidiary as at the end of the period, whereby I'll be having aspect of receivables and at the same time I'll be having the aspect of what? The payables. So therefore, whatever that will be required to do is to eliminate this completely. Will always be required to eliminate these intercompany owings as at the end of the period, Then probably we can also talk of another adjustment which is also very key before we look at our question. That is aspect to do with cash in transit as well as goods in transit. How will this happen? This will happen, say for example, we're talking of cash in transit. Cash in transit will occur when a group member probably has remitted a cash to another group member. But by the time you are closing a financial year, this cash had not yet reached the other group member. So therefore, in this event, you'll find that it as if in the books of the person who has remitted, say parent, I'll be counting as if I've paid. But in reality, in this case, you'll find that the amount has not yet reached what? The subsidiary. So therefore, always whenever I'm having such, you should always add it to our cash. I should always add it to our cash and cash equivalent. You'll find this will also be very, very easy as we'll be looking at our question. So basically these are some of the main concepts that at all, if you master them clearly, consolidation will always be very, very key. Consolidation will always be very, very key. Then maybe to summarize our important concept that we need always to have at the back of our mind before we look at our question, this is also another key element. In preparing our statement of financial position, let me show you the format of doing that, and you can always use that in your exam situation. You can always use this idea in the case of your exams. Maybe you are in an exam situation, you need to save your time. I can advise that so long as you have the format at the back of your mind, come up with this format as quickly as you can. Come up with this format as quickly as you can. Direct entries, of course, you just insert direct entries. Then whereas the one that will require workings, you can consider them as you proceed. You can always consider them as you proceed, okay? So, at this point, I want us to talk of two main aspects. The retained earnings of the parent to be reported in our statement of financial position, and the retained earnings of NCI to be reported in the statement of financial position. How will we go about it? So, determining the NCI to be reported, NCI to be reported in the statement of financial position. NCI to be reported in the statement of financial position. This is what I want us to have. I'll always be taking the fair value of NCI. Always take fair value of NCI. Always take fair value of NCI. Okay? You come and take your talk of post-acquisition. Remember when you started, I talked of something of what? Post-acquisition. So talk of post-acquisition profit. Post-acquisition profit. This post-acquisition profit, of course, you are going to deduct the adjustments to do with the aspect of unrealized profit. So in this case, or rather you can have post-acquisition profit of the NCI share, of course. If at all we had UPS, deduct UPS, this is NCI share. Then also you can deduct probably the aspect of maybe the aspect of say like depreciation. Talk about maybe aspect of you can talk of the fair value adjustment. Fair value adjustment, which in this case we'll be looking at if at all I'll be having the component of depreciation on it. Of course, that is a depreciation in relation to that. If we are undercharged, if I'm having a revaluation gain, of course, that is to say our depreciation will be in excess, or rather our depreciation will be less. So therefore, deduct that component. In this case, you're looking at what? The aspect of post-acquisition. Post-acquisition. We deduct the depreciation. So that as at the end of the day, whatever that I'll be having here, this will give us what? The NCI to be reported. The NCI to be reported in our statement of financial position. What about the retained earnings to be reported in the SFP? Retained earnings of the parent. Talk of retained earnings of the parent. Retained earnings of the parent to be reported, of the parent to be reported, in the statement of financial position. How will we go about this? You'll also find that this one will also be very key, because actually I've forgotten impairment loss. Sorry. If you're also having impairment loss, you can also have it what here? The NCI share. NCI share, of course. NCI share, you can have it there. Okay? So for retained earnings of the parent to be reported in the statement of financial position, again, you'll find that this will be simple because I'll be taking our retained profit brought forward, retained profit brought forward, of course, of the parent. I'll also be taking here another item, which in this case you are going to term it as maybe profit of the year, profit for the year of the parent. I'll be having it at that point. Then talk of post-acquisition profit, post-acquisition profit, of course, of what? Of our subsidiary. But in this case, you're talking of what? Group share. You're talking of group share. We less any UPS group share, or if it was downstream, I'll be taking the whole amount. We less any impairment loss. We less any impairment loss. We less any impairment loss. Of course, group share. Then we can also deduct any component of the fair value adjustment. Fair value adjustment. In this case, you're looking at what? That component of depreciation that we had. If, of course, if we had a gain. So that as at the end of the day, this should give us what? The retained earnings to be reported in the statement of financial position. That will give us the retained earnings to be reported in the statement of financial position. So, ideally, this is everything that you need to know. Basic entries that if you master them clearly, consolidation will always be very, very easy. Consolidation will always be very, very easy. So, in this case, in our next session, we are going to do a question more so of deferred payment, deferred cash payment, so that once you have this, you'll find that things will always be very, very easy on our end. So up to this point, guys, thank you so much, and let us meet in the next session. I think you'll also find the link to the next video. Just below this video, you'll find the link to the next video. To that point, guys, thank you so much, and let us meet in our next class for consolidation. Thank you.